Warren Buffett is sitting on an absolutely staggering $373 billion in cash and short-term investments. This isn't just a number. It's the largest cash hoard in Berkshire Hathaway's history, and it represents nearly 30% of the company's entire market value. When the world's greatest investor chooses cash over stocks at this scale, every investor should pay attention. At 94 years old, Warren Buffett is preparing for his final act as CEO of Berkshire Hathaway. But instead of going out with a bang, he's building the ultimate financial fortress. This massive cash position isn't just conservative investing. It's a deliberate signal that the Oracle of Omaha sees storm clouds ahead. The man who famously said, "Be fearful when others are greedy," is practicing exactly what he preaches. Look at Berkshire's stock performance over the past 6 months. It's been remarkably volatile for such a massive company. From a peak near $795,000 per share down to recent lows around $709,000. That's a swing of nearly $66,000 per share. But here's what's fascinating. Even as the stock fluctuates, Buffett keeps building that cash mountain. This tells us he's not concerned about short-term price movements. He's positioning for something much bigger. Let's put this cash position in perspective. With $373 billion in cash, Berkshire could literally buy entire companies without borrowing a single dollar. That's enough to acquire Netflix, Adobe, and Salesforce combined. Or think of it this way. It's more than the GDP of countries like South Africa or Ireland. But here's the kicker. This cash is earning Buffett roughly $20 billion per year in interest alone at current rates. But why is Buffett choosing to earn 5% on cash when the S&P 500 has delivered double-digit returns in recent years? The answer lies in his investment philosophy. Buffett has always said that rule number 1 is never lose money, and rule number 2 is never forget rule number 1. This massive cash position isn't about missing out on gains. It's about being ready when everyone else is forced to sell. History shows us that Buffett's best investments have come during market panics when others desperately need cash. To understand just how unusual this cash position is, let's compare Berkshire to other mega-cap companies. Apple, despite being a tech company with massive cash flows, holds about $162 billion in cash. Microsoft has roughly $144 billion. Even Google's parent company, Alphabet, sits at around $110 billion. Buffett's cash hoard is larger than all of these combined. And remember, Berkshire isn't a tech company generating massive margins. This is deliberate capital allocation at its most extreme. Here's what should really get your attention. Buffett has been a net seller of stocks for 8 consecutive quarters. That's 2 full years of reducing equity positions while building cash. This isn't market timing. This is systematic preparation. The man who built his fortune buying undervalued companies is telling us through his actions that he can't find attractive investments at current prices. Let's break down what Buffett has been selling. His biggest move was trimming Apple, Berkshire's largest holding, by more than half. He also completely exited positions in several banks and reduced stakes in other financial companies. Meanwhile, his buying has been minimal, focused mainly on his own company's stock through buybacks. This pattern screams caution from someone who's seen every market cycle over 7 decades. Now, let's talk about what this means for you as an individual investor. When someone with Buffett's track record and resources chooses cash over stocks, it's not because he's lost his touch. It's because he sees risks that others are ignoring. Think about it. If you had unlimited capital and 70 years of investing experience, what would make you sit on the sidelines? The answer is simple. When you believe that patience will be rewarded with better opportunities ahead. Here's how Berkshire's portfolio looks today compared to historical norms. Cash and short-term investments now represent nearly 30% of the total portfolio, the highest percentage in the company's modern history. Compare this to 2008, when cash was just 8% of the portfolio, or 2016, when it was around 12%. This isn't just conservative positioning. It's unprecedented defensive strategy from someone who's always been an optimist about American business. Let's calculate what this cash position represents in terms of buying power during a market crash. If stocks fell 30%, similar to what happened in early 2020, Buffett's $373 billion could potentially buy $533 billion worth of assets at today's prices. If we saw a 50% decline, like in 2008-2009, that buying power jumps to $746 billion. This is why cash isn't just safety. It's optionality. It's the ability to be greedy when others are fearful. Looking at Buffett's history, his biggest wins have come from deploying cash during market stress. In 2008, when everyone was panicking, he invested $5 billion in Goldman Sachs and another $3 billion in General Electric. During the 2020 pandemic crash, while others were selling, he was buying. The pattern is clear. Buffett builds cash during good times and deploys it during bad times. Right now, we're clearly in the building phase, which suggests he believes the deployment phase is coming. But here's what's different about this situation. Buffett is 94 years old. This isn't just about market cycles anymore. It's about legacy. He's not building this cash position for himself. He's building it for his successors at Berkshire. This is his final gift to the company. A war chest so large that it can take advantage of any crisis that comes after he's gone. That makes this cash position even more significant. It's not just market timing. It's institutional preparation for uncertainty. Let's examine what specific risks might be driving this defensive positioning. Current market valuations are stretched by historical standards. The S&P 500 trades at about 25 times earnings compared to a long-term average of 16. Meanwhile, corporate debt levels are near all-time highs. Geopolitical tensions are rising, and we're facing potential policy changes that could impact markets. Buffett has lived through enough cycles to recognize when conditions favor patience over action. Here's a sobering look at how Berkshire's cash position has grown over the past 5 years. From around $130 billion in 2019 to $373 billion today. That's nearly a 200% increase. But notice the acceleration. Most of this growth has happened in the last 2 years, coinciding with market peaks and increased volatility. This isn't gradual accumulation. It's aggressive cash building that suggests Buffett sees something specific on the horizon. Let's look at what this means for different types of investors. If you're young, with decades until retirement, Buffett's caution might suggest building larger cash reserves than you normally would, maybe 10–15%, instead of the typical 3–5%. If you're near retirement, his positioning validates having substantial defensive allocations. And if you're an active investor, his cash build suggests being more selective and patient with new positions. The key insight: even aggressive investors should have dry powder for opportunities. Here's a practical exercise. Let's calculate what a Buffett-inspired portfolio might look like for an average investor with a $100,000 portfolio. Instead of the typical 90% stocks, 10% bonds allocation, you might consider 60% stocks, 15% bonds, and 25% cash. Yes, you'll miss some upside if markets continue rising, but you'll have $25,000 ready to deploy when opportunities arise. At current savings rates, that cash generates about $1,300 per year risk-free while you wait. But let's address the elephant in the room. What if Buffett is wrong? What if markets continue climbing and cash becomes a drag on returns. Here's the thing. Buffett isn't trying to time the market perfectly. He's managing risk and positioning for asymmetric opportunities. Even if he's early by a year or two, having cash when others need it most has historically generated his best returns. The cost of being early is usually much lower than the cost of being unprepared. Here's perhaps the most important insight. Buffett's $373 billion isn't just about Berkshire Hathaway. It's about the entire market ecosystem. When the world's largest and most patient investor is sitting on the sidelines, it removes a major source of buying pressure for markets. This creates a feedback loop, where fewer buyers can lead to increased volatility, which then validates the decision to hold cash. It's a self-reinforcing cycle that every investor should understand. Let's look at what sectors Buffett has been avoiding in his recent selling. Technology stocks, despite their strong performance, have been reduced. Financial services, traditionally a Buffett favorite, have seen significant trimming. Consumer discretionary stocks have been largely avoided in new purchases. The pattern suggests he's concerned about valuations across multiple sectors, not just isolated pockets of the market. This broad-based caution is what makes his positioning so noteworthy. So what's the practical takeaway for your investment strategy? First, consider increasing your cash allocation beyond normal levels. Not to time the market, but to have options when volatility increases. Second, be more selective with new investments, focusing on quality companies at reasonable prices rather than chasing momentum. Third, prepare mentally for increased market volatility as fewer big players provide buying support. Finally, remember that cash isn't just safety. It's ammunition for when others are forced to sell. Let's put this in historical context by comparing today's situation to previous market peaks. Before the 2000 dot-com crash, Buffett was also criticized for holding too much cash while tech stocks soared. Before the 2008 financial crisis, he was building cash while others were leveraging up. In both cases, his patience was rewarded when markets eventually turned. Today's setup has eerie similarities: high valuations, widespread optimism, and Buffett building his largest cash position ever. Here's a final calculation that puts everything in perspective. If Buffett deployed just half of his cash position during a 30% market decline, he could potentially acquire companies worth $266 billion at today's prices. That's larger than the market cap of companies like Tesla, Nvidia, or Meta. This isn't just about having cash. It's about having enough cash to reshape entire industries when opportunities arise. That's the kind of financial firepower that only comes from years of patient accumulation. Warren Buffett's $373 billion cash position isn't just a number. It's a message. After 7 decades of investing, through multiple market cycles, economic crises, and technological revolutions, the Oracle of Omaha is telling us that patience and preparation matter more than participation in every rally. His final act as CEO isn't about one last big bet. It's about building the ultimate foundation for whatever comes next. For individual investors, the lesson is clear. In a world obsessed with the next hot stock, sometimes the smartest move is simply waiting. What do you think about Buffett's massive cash position? Are you adjusting your own portfolio to be more defensive, or do you think he's being too cautious? Let me know in the comments below. And if this analysis helped you understand the implications of his strategy, make sure to subscribe for more deep dives into what the world's best investors are really doing with their money. This video is for informational and educational purposes only, and should not be considered personalized investment advice. All investing involves risk, including the potential loss of principal. Past performance does not guarantee future results. Please consult with a qualified financial advisor before making any investment decisions.